Hello, everyone, and welcome to the second quarter installment of Personalize and Customize Your UMPIP, the United Methodist Personal Investment Plan. My name is Frank O'Brien. I am a Senior Benefits Educator here at Wespath, and next to me today is Cheryl Hatcher.
Hey Frank, how you doing?
Very good. Cheryl and I are both very pleased to be with you, to all of you again today. Cheryl and I did Q1, and we'll see how Q3 and Q4 goes relative to staff that participate. A few housekeeping items before we get started. On the toolbar on your webinar there are 4 documents: the UMPIP at a glance, the Housing Allowance Exclusion Worksheet, a frequently asked question document for life stage programs that we have, and a rollover form that is available to you. You can download that during the course of today's webinar. This will be recorded and distributed via email within a few days of the conclusion of this webinar. There is a question box, and 2 of our colleagues, Todd Christoffel and Todd Creviston and Bob Christoffel, are working the question box, so please feel free to ask questions as we go through the material this afternoon. And we will be providing a survey to you with the recording of this webinar, asking for your feedback relative to how you think these presentations are going and what material you would like to continue to hear as we go forward. And what I can let you know, and I did neglect to put a slide into the slideshow, but what I can let you know is that for the third quarter that we'll have in September, we're going to be focusing in on the investment funds, asset classes, life stage investment management, areas around the investment side of the plan. And then in the fourth quarter, we're going to be talking about financial planning, retirement income planning, tax efficiency planning. So this is all feedback that we've received from you over time that we're trying to formulate into ongoing webinars for all of you. So with that, this is the team that is with you today. You can see Cheryl and myself there, as well as Bob and Todd. And then just a reminder about Wespath. We are actually the largest reporting faith-based pension fund in the world. We are a large organization. We have been around for 115 plus years. We have approximately $25 billion in assets under management. That number moves as the markets move. We are a not-for-profit organization, so there's no stockholders or shareholders that are receiving any profits from us. Everything stays within the context of Wespath, where it belongs for all of us. And all of us gets to about 100,000 participants. That's clergy, lay employees, retired, active, surviving spouses, and the like. All comes up to 100,000 participants. It includes all of us here today. And our mission, as it always is caring for those who serve by providing investment and benefit services that honor the mission and principles of the United Methodist Church. For today's agenda, I'm going to briefly go through the contribution options. We'll review that with you, go through the investment election options that are available to you. Again, we're going to have a breakout webinar the next time that'll focus more on that. Then I'm going to turn it over to Cheryl. Cheryl is going to spend time today, really the theme for today's webinar is account access. Life happens. It's a retirement plan. You don't want to be tapping into your retirement plan before retirement, but things happen. I've done it. Many of us have done that. Cheryl's going to walk us through those various options, as well as what it'll look like in retirement as well. And then always close with the participant experience, the resources that are available to you. So what is UMPIP? It is a defined contribution 403B plan. It's a qualified retirement plan. This is an account balance plan. You can have employer contributions going into the plan by virtue of how the adoption agreement is created and the relationship you have with your employer and your employer with you. But primarily we'll be thinking about and talking about the participant contribution accounts. And this then creates an account balance. This is an account balance for you to continue to accumulate your account balances over time to generate that retirement income for you. And it's participant-directed investments. We have our family of Wespath investment funds. You can self-manage if you want to self-manage. You can use life stage investment management. We'll talk briefly about that, but again, in the Q3 webinar, we'll talk about that in more detail. There's a lot of advantages when you personalize and customize a plan like the UMPIP. You have the type of contribution that you want to contribute toward. You can do before tax. You can do Roth, which is a form of after-tax, or an after-tax contribution source itself. and you can roll over money from other qualified retirement plans into the UMPIP. There's some tax efficiency strategies that are available to you. You're doing the before tax contribution, you're deferring taxes now, knowing you'll be paying some taxes in retirement on those distributions. Or if you're so inclined to go to a Roth account, well, actually you pay the taxes now up front, but you can receive tax-free income as long as it becomes a qualified Roth account. You have the Wespath family of funds that you can allocate across a diverse set of investment funds, everything from a stable value capital preservation fund to a high-risk international equity fund and all that in between. You can self-manage if you so choose and you're comfortable with the investment markets and asset classes, or you can use our program, Life Stage Investment Management. And then also there are autopilot solutions. Life Stage Investment Management is one of those solutions where you're asking us to tailor your investment allocation and manage that for you over time. You can do auto escalation. The adoption agreement with your employer may be set up that you begin contributing at one particular level, and for a number of years it goes up by a percentage until you hit like a maximum level. So let's say 8%, for example. So there's ways in which you can take advantage of this plan and really tailor it towards your needs now, and they may change and modify over time, and you can make those changes within the context of the personal investment plan as you go along. As far as contributing to your UMPIP, well, first you want to determine how much will you be contributing, and you can do that on a dollar amount basis, you can do that on a percentage basis. We always highly recommend you do it on a percentage basis because over time we get wage increases. And whereas you may not be able necessarily to increase the amount that's going into the plan, but you have a percentage against the raise, more money will be going in naturally just doing the math from there. So you don't necessarily have to do anything. If you're doing a dollar amount and you get a raise, you have to remember to go in and make that change yourself. So just an efficient way of taking advantage of the plan option. You determine how to contribute, what contribution source you want to contribute, and how you want those contributions to be invested over time. And you can modify that over time. You're probably familiar with these by now. We have the before tax, after tax, and Roth contribution accounts. The before tax, the words are kind of telling us what's going on there. You have your gross pay, let's say, for the month, and before taxes are taken, your contribution dollars are calculated and put into the UMPIP plan. And then the taxes come along. The tax man cometh at that point in time. Just to note, for lay employees who may be on today's webinar, FICA does get taken before the contribution is calculated. For clergy persons joining us today, the contribution gets calculated before your SECA will get calculated and any other federal or state taxes if it applies. We have the Roth contribution account. This is a form of after-tax contribution account. But the way it works is we're actually taking the total, you're looking at your total gross amount of pay for the month, taking the taxes out, and then calculating the amount you've chosen to go into the into the Roth account and depositing that into the Roth account. By doing it, you're paying upfront the taxes on that payroll cycle. And if you do that, and then you qualify that Roth account, which is fairly simple to do, in retirement you can receive distributions from the account tax-free. To qualify the account, you have to be over age 59 and a half. That's a magic number in the retirement world. And that very first contribution into the Roth account has to be 5 years old or older. Not every contribution, not every year on a rolling basis, just that first contribution. Death, disability, it becomes a qualified account. But just on an ongoing basis, just recognize age 59 and a half, that first contribution is 5 years old or older. It's a qualified Roth contribution account. This is a defined contribution account because the IRS defines for us how much we can contribute on an annual basis, and this amount goes up each year with the rate of inflation. For 2023, the base amount for Roth and or the before tax contribution is $22,500. For those 50 and older, there is a catch-up contribution at $7,500. So for that cohort, $30,000 is available to contribute into the plan. And in conjunction with other employer retirement contributions coming through, the overall amount on an annual basis for this year cannot exceed $66,000. Now, we grant you that these are robust numbers. However, if as an individual or as a household, you have the ability to hit that threshold and maybe even have a little bit more space in your monthly income to continue to contribute to UMPIP, this is where the pure after-tax contribution account can come into play. So this after-tax contribution truly is what the words are saying. You're getting your monthly pay, then there's taxes, and then the calculation of the contribution amount is then put into the UMPIP. Upon distribution, the contribution dollars themselves, they won't get taxed again. That would be double taxation. But the earnings on that, regardless of age and number of years, the earnings on that will be taxable. So again, things to be thinking about when we're thinking about retirement income planning, financial planning, is the tax efficiency side of things as well. For those of you who have prior employer accounts, prior work where you have an old 401k, another 403b, governmental 457 plan, or if you just created your own traditional IRA, you can roll that money over into the UMPIP plan. We really administer what we call a direct rollover, working with Cheryl here on my right, who actually runs the rollover program here, the rollover in program here. We have a form that gets completed. Cheryl will work with the current custodian or holder of those retirement assets and have that roll over to your UMPIP and get invested as you have your investment allocation set up in the plan. So something to think about. It's a good idea, I think, to have all the retirement stuff put together. It's not all of your eggs in the basket. It's just the retirement stuff in a singular place so you can continue to look at it and monitor it over time. As far as investing in the account is concerned, well, there are benefits of investing with Wespath. First of all, we practice sustainable investing. And that really means two things to us. The first is, as I said, we've been around for a long time paying out retirement benefits. We're in a good position right now to continue to do that as far as the eye can see, and we're certainly committed to doing that for a very, very long time. But sustainability also means upholding the values of the United Methodist Church. We are an ESG-oriented investment firm. Environmental, social, governance issues, climate issues. We will not invest in certain countries or companies that do not match up with our values. So when we talk about sustainability, it's for the long haul to pay benefits, but it's also to uphold the values of the church. We have a diversified set of investment options, as I indicated, from the very safe and conservative to the more high-risky, and we'll take a quick view at that momentarily. And we have competitive returns relative to our benchmarks. Because we're a not-for-profit, because nobody receives any expenses or any commissions, any commissions or anything like that, that money gets to stay where it belongs, which is within the funds. And then our operating expenses of those funds can also be managed in such a way where they're very reasonably priced, which keeps more money in our investment funds, which gives us a greater return over time. And then through the use of those funds, you do have the ability to self-manage or use live stage investment management. This is just a quick review of the investment funds that we have. Again, next time we'll go into more depth on these. But on the left-hand side, you can see that stable value fund. Kind of looking at this as a risk-return kind of barometer. The lower the risk, the lower the potential rate of return. Go all the way out to the right-hand side there. The higher potential risk, the higher potential rate of return. Now, this is a long-haul view, historical view of the markets. We do understand that at any particular point in time that can get turned over on its head, and we've experienced that just a couple of times in the last 3 or 4 years. But you can see how we have these allocated. We have our income funds. They are designed to have some risk to get some return. We have our equity funds designed to add on more risk with more potential rate of return. And then in all things as far as your investments are concerned, and I've mentioned it several times already, you can self-manage your accounts. You can choose your own mix. You can see that on the right-hand side there. Or you can use live stage investment management where you're asking us to tailor the investment allocation for you. But right there in the middle, EY Financial Planning Services. I think regardless of which side you land, comfort in doing your own thing or wanting to use live stage investment management, using EY as a resource, as a sounding board, just to make sure you continue on your plan along the way is something that we highly, highly recommend. So now we're going to switch over to Cheryl, who's going to talk about accessing your account. Again, I just wanted to kind of give an overview of the account balances available, or the contribution types available, hit on the investment funds briefly, and then we're going to go into more detail here. And Cheryl's going to walk us through the various ways in which we can access our account. Always recalling it's a retirement account. We don't want to access it if we don't have to, but life happens and we realize it does. And the plan is designed in such a way to help you deal with those things over time. So, Cheryl?
Correct. All right. Thank you so much, Frank. A lot of great information. So let's get into some more here. So to access your account for your UMPIP plan. All right. So we know that this can happen at different times, various times throughout your career here. So you can actually make that withdrawal from your UMPIP account. But we do know that I want you to be aware that this can impact your financial security in retirement if you do take that money out, because the plan is for your retirement. If you have any questions, of course, please contact our customer solutions team and they'll be able to help you through that as well. Again, we want you to make sure that you talk with your tax preparers and so that you do understand the tax consequences of making a withdrawal from your retirement plan. But again, if you need to access, we know that life happens, as Frank had mentioned. Life happens, and you may need to take that money out. It is your money. You may need to take that out. So there are certain conditions prior to retirement, such as a termination or maybe even a separation of service. Those are reasons that you can access your account. But again, this account is for retirement, so we'll get into that a little bit later as well, showing all the different options that you have in retirement. Again, prior to retirement, there are other ways that you can access that money, and let's get into those. So again, if you need to access your money, there are ways that you can do it. These are the different types of ways that you can actually access your money. So let's go through these, and then on each slide after this, we'll go into these in a little bit more detail. So you have the hardship loans, hardship withdrawals, maybe rollover of your rollover account withdrawal, in-service withdrawals at the age of 59 and a half. Again, Frank had mentioned 59 and a half is that magic number for retirement, or the magic age for all of these plans. You can actually do a disability withdrawal if you happen to be disabled, or if you're a qualified military service, you can actually have withdrawals for that as well. So let's talk about these a little bit more in detail. A hardship loan. You can actually take up to 50% of your vested account balance as out of your account, but the maximum for that amount that you can actually have as a loan would be $50,000. Due to the processing paperwork that's needed, the minimum amount for a loan would be $1,000. Now, you would need to submit information as far as to make this a qualified loan, but you would just need to submit that information, and then we would be reviewing it for that determination. If this was going to be for a purchase of your primary residence, or maybe even for the down payment of that residence, you can have up to 15 years to pay that money back to yourself. Now, you don't need to take that full 15 years, but you do have that amount of time to actually pay that back again to yourself. If it's for something other than for a primary residence, then it's considered a general purpose loan, and you have up to 5 years to pay that back. Now again, you don't need to take the full 5 years, maybe 3 or 4, but you do have the full 5 years to do that. Now, since the money is not going to be in your account, we want to make sure that you are actually kind of paying yourself back, and the way to do that is that we're going to be charging interest on that loan. Now, the interest on these hardship loans is actually going to be the prime rate, plus we add on 2%. Now, over the last year, this amount has fluctuated quite a bit, so if you want to know what that amount is going to be, feel free to contact our customer solutions team, and they can actually let you know what that amount is for now. When you actually have set up this loan, you will be asked for your banking information. That is so that we can actually do a direct debit for that loan repayment. So that'll be taken care of automatically for you, so you don't have to worry about that. Now, we know that sometimes you can possibly be late on these payments, maybe 1, 2, or 3 of these payments. So there are some tax consequences for this as well. So I just want to let you know about that, and we'll get into that right now. As far as these, if you have one outstanding payment on the last day of the quarter, following the quarter when the repayment was due, you're considered in default. Now, we understand that things happen, and the reason for a default could be potentially maybe there wasn't enough money in the account at that time the direct debit was going to be taken, or maybe you wound up changing banks and you maybe forgot to let us know of the new bank information. But if you do wind up going into default, this is going to be considered a taxable event, and that's going to be deemed as a distribution then to you. If you're under 59.5, that magic number again, you are also going to be charged a 10% tax penalty. Now, since this is going to be deemed a distribution, you are going to be receiving a 1099-R form at the end of the year. Now, if you need to maybe make another loan in the future, this could honestly be, maybe restricted or unavailable to you by your plan sponsor if you were in default. So we talked about the loans. Now we can talk about the hardship withdrawals. So this is actually where you can actually take money from a before-tax Roth or an after-tax account. You can actually, if you have a rollover, you can actually take that money at any time for whatever reason. But for a hardship withdrawal, you do also need to provide proof of that hardship. Submit that information over to us, and then our customer solutions team will actually be reviewing that as well. In your request for that withdrawal, you can actually include the estimated federal and state income taxes in that amount as well. So just wanted to make sure you have all that information. Now again, there are reasons for hardship loans or hardship withdrawals. So we know that this can be a devastating time, but we do want to make sure that you're aware of that and that documentation does need to be provided to us. So here are some examples of these types of hardship reasons. These could be something such as unreimbursed medical expenses, funeral or burial expenses. These can get to be pretty high, and so unfortunately if you don't have that, this could be a good reason for it. Tuition or educational fees for post-secondary education. We definitely know that education can be very high, so you could take money out of your UMPIP account. As I mentioned previously, if you are going to be taking money out for your principal residence, maybe this is the first time you're actually buying a home. This money is available to you, so you could do it as your financing for your purchase, or even for that down payment of that first home. Or maybe there's been some damage to the home. Maybe a natural disaster went through and you need to make some updates and repairs to your home. This is another good reason to actually take out a hardship loan as well. Now, just want to make sure that you're aware that there are tax considerations for this, and this is considered a taxable distribution. It's going to be taxed as ordinary income in the year that you actually receive that. Again, if you're under 59.5, then this is going to be a 10% early withdrawal penalty for you, okay? So I want to make sure that you're aware of all these different tax complications or considerations. The next we have are in-service withdrawals. So this is for if you have a rollover account, you can actually make that request for that money from your rollover. Again, if you're under age 59.5, you will have that 10% tax penalty. But if you're over 59.5, there's going to be no 10% tax penalty for you. For the in-service withdrawal at age 59.5, there's going to be no tax penalty, and this can actually come from your before-tax Roth and or your after-tax account that you have on account with us. Now, talking about disability withdrawals, this is something where you may be talking with several different departments within Wespath, but in order to satisfy being eligible for a disability withdrawal, you do need to satisfy that definition of disability. There is an actual disability form that has to be completed, and if you're able to actually satisfy one of the exemptions on that disability form, then there's going to be no tax penalty for you if you wind up taking a disability withdrawal. The access is determined by the account type, so that can be the plan sponsor account, rollover after tax, or the QVAC accounts. So again, if you're getting to that point where this might be an option for you, definitely contact our customer solutions team. We just want to make sure that everyone's aware that this is a type of withdrawal that's out there, and that if you feel that you're deemed qualified for this, go ahead and try to take this out as a withdrawal. Qualified military withdrawals. Now, this is going to be eligible for military reservists as well as the qualified military withdrawal. You will need to submit your orders that you've received for this. Again, submit that information to our customer service team, our customer solutions team, and they will walk you through each of the steps that are involved, and they'll take it from there and walk you through every step of the way. Now, as far as a separation of service, for a clergy person, you must terminate your conference membership in order for this to be deemed a separation of service. Or if you're a lay employee, you will just need to leave your plan sponsor's employment, and so that you're no longer working with them. And then you could actually take out your money out of your UMPIP or have it transferred to somewhere else. Now that we've gone through the other options of ways of actually taking money out other than retirement, let's talk about retirement now. That's what the money is there for. So let's talk about your retirement options. You have distribution options, which are the lump sum or even a partial lump sum for this distribution. Now, all of these other types of funds that we have at Wespath, which we will go into in a later session, all of these different funds, they could actually go into your UMPIP, and they would have the same type of options. So again, lump sum or partial lump sum distributions you can do. Again, this could be another great way to fund your first home, whether that's the down payment or actually financing your home. Take the money out for a full or partial lump sum. But what a lot of people do, and the most common way, is to actually have a cash installment. This is actually where you can actually tell us how much to have per month. Now, if that amount, maybe you need $1,100 for 1 month, or maybe $1,400 for the next month. What you're doing is you are actually telling us, you are self-managing how much you want in retirement. Or if you want us to actually mathematically determine how much you should be getting per month, mathematically to last your lifetime, then you can actually utilize the life stage retirement income. Now again, you don't need to do anything with these accounts either. You can actually leave them on account until you are at that age of the required minimum distribution, or we call RMD. So we will talk about RMD in just a little bit. But one thing we also wanted to mention to you is that the plan loans that I talked about, if you're an active participant, these are actually also available to you in retirement. So if you want to take out a loan out of your account, you can certainly do that as well. So now talking a little bit more about the required minimum distributions, or are the RMDs. These will begin no later than April 1st of the following year after you turn the age of 73. This age just increased as of December of last year to age 73, and it'll keep going up over the next few years. This does apply to all of your defined contribution accounts. So if you wind up, Wespath was actually to send you out a letter when it's actually time for you to take that RMD. So if you wind up waiting until the first quarter after you're turning 73, then you will have an RMD for that time period, but then you also have another one for the December 31st of that year, of that current year. So you could have two in 1 year. Now this does apply to all of the benefits that you have through Wespath, so MPP, CRISP-DB, the pre-82, if that's also available to you. You must start taking these as of your RMD age. So I just want to make sure that you're aware of all of that. If you're already receiving a benefit at that time, we will calculate what the difference is. So if you're already receiving maybe $1,000 a month, but that equates out to $12,000, but you should be receiving $20,000 for your RMD, then the difference between what you should get and what you are receiving, the difference will be your required minimum distribution that will be sent out at the end of the year. All right, now we've gone through all of those. Let's change topics and go into the housing allowance exclusion. The housing allowance exclusion in retirement, let me just tell you, I wish I had this benefit. This is such a wonderful benefit for clergy. This is where what's going to be excluded is going to be the lowest of three numbers. Okay, three numbers. The first number that you actually don't need to calculate, this one number, is going to be the amount that you actually receive in income from Wespath. So how are you going to know that? Well, we will be sending out a 1099-R form. That form will actually have the amount that you received in retirement from Wespath, from your Wespath funds. So that's item number one. Item number two is actually where you're going to need to do some calculation. So this calculation is actually coming up with all of the expenses that you have for your housing. So on the handout section of this of your toolkit is the actual housing allowance worksheet. So I want you to be able to pull that up, so and actually download that. On there, it has information as far as how to actually calculate what expenses there might be. This is going to be for your mortgage. It can be your interest, your insurance, your taxes, your utilities, your internet, any cleaning expenses that that you're using. Add those all up on a spreadsheet, calculate that, and you want that number to be as high as possible because, again, we're looking at the lowest of these three numbers, okay? So that's your second one. So that's your second number that you're calculating of those expenses on that spreadsheet. The third is actually the fair rental value of your house. Now, what you want to do is the IRS is actually looking at this to make you do this comp letter. So what we want you to do is hopefully you have a friend or maybe maybe somebody in your parish you can actually go to and actually say, hey, I need a comp letter or what's called a compensation letter. And that letter will actually have information regarding how much you can rent your house for, including furnishings and utilities in the area that you live in. That letter you can have, and then you will see how much that will be for the year. So now you have three numbers. You've got how much you've received from us, the calculation for all of your housing expenses, and your fair rental value of the house. Now, I'd like to be able to show this as an example, so this is what we're going to go through now. So let's look at this as an example. So let's say that you're receiving $2,000 a month from us, okay? So as far as the income that you receive from us, that then would equate out to about $24,000 in a year, okay? So that's the 1099-R that you're going to get from us, and that's going to be the $24,000. So that's, item number one. From your calculation on your spreadsheet, let's say that number actually equates out to about $20,000. Okay, so that's item number two. And as far as the fair rental value of the house, maybe the realtor has actually told you that you can actually rent your house, again including furnishings and utilities, for about $1,750 a month. Okay, so that sounds like a pretty good number. So that actually you equate that out into a yearly amount. That's actually $21,000. Okay. So looking at these three numbers, the income you received, the actual expenses, and the fair rental housing value, you take the lowest of these three. So for this example, the housing allowance exclusion would actually cannot exceed $20,000. So what we're going to do now is you take that $20,000 amount, subtract it from the actual income that you've received, which is the $24,000, and then you actually have the taxable amount of $4,000. Now this is actually before any other adjustments or credits that you have. So that actually comes right off the top. So again, I'm sure Frank is nodding yes. We would both love to have this type of benefit ourselves. But this is a wonderful benefit for clergy, and we want to make sure that you're aware of that. So if you wind up taking a distribution, this amount can affect your housing allowance exclusion. So as far as the housing allowance exclusion, it is, again, available for retired clergy. It is not applicable to surviving spouses if the clergy person passes away first, but it does apply if it is a clergy couple. Now, on the back of the housing allowance worksheet, there's information, there's actual documentation here that you want to actually provide to your tax preparer. And make sure that's included with your taxes, showing that you know that you can actually take that as a housing allowance exclusion. As far as how this is calculated, it's actually come up at your annual conference, set by at annual conference, and then this is actually documented in your conference journal. So all that information for a housing allowance exclusion, which is a really wonderful benefit. All right, so now we're going to pass it back over to Frank, and he's going to take it home and go through those participant resources. So here you go, Frank.
Thank you very much, Cheryl.
Thank you.
So as you just heard, there is a lot of options. There's flexibility. There's certainly some requirements that wrap around certain ways in which you can get access to your accounts. We've really just kind of hit on the high points of each of those things. But you can make a decision about a loan. You make a decision about a hardship distribution. If you have the rollover in, do you need to take a little of that out? If you're disabled, military, those types of things. We always recommend people, if they're thinking about accessing their UMPIP, to reach out to the resources that are available to them. And there is, like I like to say, a plethora of resources that are available to you at Wespath. And here again, we're only going to be hitting on a few of them. First of all, benefits access, our web portal, your web portal for you to access the retirement plans and other benefits that you have provided to you through your employer, your annual conference, etc. If you have not yet registered for benefit access, please do. It's a very important step we all believe you should be taking in terms of kind of getting engaged in your own retirement plan. Very simple to do, takes 3 or 4 minutes. We will authenticate back and forth to your cell phone with a security number, but we just want to secure the account before people start getting access to it. Once you start looking at benefit access, you can get your quarterly statements. A PDF is attached just several days after the quarter end that you can see what happened to your account balances during that time period. On benefit access, you can see your actual account balances in real time. What is the market value as of today or as of last night's close for all of the different accounts that I have? How much CRSP, defined benefit service time, have I accrued? You can see all of that. There's tools that we provide to you. You can do projection tools. You can run your own retirement projections with the options that are available to you for that. You can do a readiness tool, where it's a gap analysis, where you actually feed in some additional data from outside of your Wespath plans, but you get a better feel as to how you're doing relative to savings for retirement income against your current compensation we have for you on file. Investment information, you'll hear about this in the third quarter one. There is a lot of investment information available to you. High-level information, just kind of good brief overviews of the investment funds, or deeper, more detailed information for those who want to get a little closer to the investment funds, the asset classes and all of that. That information is available to you as well. Educational resources, when you look at benefit access and you look at a screen on the right-hand side, there's always links to other materials, other information available to you that complements whatever is on the central part of that screen. And we always have the Learn tab up on top of benefit access as well. And then beneficiary designations. We should all have our beneficiary designations in good working order. God forbid something happens to us, me, my spouse, what have you. You want to make sure that your retirement accounts go to the person or persons or place that is important to you. So periodically check your beneficiary designations. You can see your Wespath beneficiaries on benefit access, but we broaden that out to other things that you and your spouse may have where a beneficiary can get attached to it. And again, we're just hitting on some of the points and some of the opportunities you have by taking advantage of the benefit access portal. EY Financial Planning Services, we talk about them often and for good reason. They provide holistic, household, comprehensive financial planning services for us. But they also provide services on just individual financial topics. So it can be the bigger picture financial planning, or it could be the do I buy a car or do I lease a car type of dynamic. EY is available to help you with that. They have a lot of educational resources on their website, wespath.eynavigate.com. It's one-on-one guidance. They will not and cannot sell you anything, so it's not like they're going to look at an insurance policy and say, I can get you into something better. They won't do that. They will just work with you and your household to look at things that are of importance. It could be that comprehensive retirement plan, or it could just be buying a home, a car, a major appliance. How do we want to deal with the investments that we have? What kind of contribution type should I be using at this particular point in my ministry or in my career, at this particular age, if you will? You can work through that with them. They can model numbers for you to help you along the way. Within the investment funds, we have a thing called operating expenses. Right? It kicks off the top of the investment funds. It pays our overhead. EY is covered in that. So we all pay for EY, but it's kind of free because there's no out-of-pocket expense to us. There's no limit on the number of times you can call them, no limit to the number of hours that you can use them in a given calendar year. So we often shout out the importance of taking advantage of EY. As far as educational information is provided, EY runs a webinar series on their own. Each month they have a theme that they're going to be applying. So as we can see upcoming in July, make your retirement income last. August, demystifying Social Security. I know I'm going to be paying attention to that one. And then get more out of your workplace savings plan, which is really kind of the whole idea of our UMPIP quarterly series, is to make sure you understand your retirement plan, but certainly leaning on other resources to help you think through your opportunities and availability is something that we think is very worthwhile. We have the one-on-one benefit education consultations. You go on to that link that is there. I think that'll be provided on the follow-up email as well. And you have a half an hour one-on-one consultation with myself, Cheryl, Bob, or Todd. Todd is the one on the screen there. It's not a one-and-done type of thing, so if we find ourselves running out of time, we can always schedule another one. If you really want to get deep into something and you have a financial advisor, they're welcome to join our consultation as well, as long as you are there. So we really feel that this program, which really kicked off because of the pandemic, it was already being thought about, but it became a necessity during the pandemic, has been very successful. We're proud of what has happened with it over the last several years, and we hope all of you at some point in time take advantage of that. And really one of the goals that we're trying to do is, if you're going to speak to EY, then have a one-on-one benefit education consultation, and we can help you formulate the questions that you have to make that conversation with EY that much more valuable or impactful, or whatever the case may be. And again, that's just touching on some of the resources that we have available to you. We have our customer services area. We have benefit access for you. We have the EY financial planning services. These are the high points, but we have a lot of things for you that you can take advantage of. As far as next steps is concerned, if you have not yet enrolled in UMPIP, on your personal contribution side, we recommend you do so. Just start off at a low level and try to build yourself up over time. Choose how much you want to contribute. You can do it on a dollar basis. You can do it on a percentage basis. We always pitch the percentage basis because we think it's more efficient over time. If your employer is providing an employer match, you want to know that match because you want to make sure you're maximizing that match. So if you put in 3%, you'll get a 3% match. Well, try not to put in 2% because you may not get that 3% match. The incentive there is for you to put in the 3% and to get that 3% match. And that's just an example of how that might work. Determine an investment strategy. We talk about this often. Do you want to self-manage or use our life stage investment management area? You have the resource available to you with benefit access. We have the one-on-one education consultations and calling EY financial planning services. So that gets us through this installment of the quarterly UMPIP quarterly series webinar. We've already gone through in the first quarter a little more detail on the contribution types, a little bit some on the investments. Now we've talked about, over the course of time, you may need to access your plan. How can you do so, and understanding how to do so. And again, if you're going to think about it, take advantage of the resources available before you pull the trigger to understand options you have, tax consequences that may follow. So you want to do that as well. And again, we're going to get more involved in the investments and then more involved in just thinking about things in a financial planning, retirement income, tax efficiency planning as the year rolls on. Again, we'll have that survey. Give us other ideas, other topical ideas that you may have that we can carry forward into the next calendar year. We will be rolling this forward over time. And always take advantage of the resources, participant solutions, customer service, and all of that are available to you. So with that, on behalf of Cheryl and myself, John, who's helping us here, in the studio and the rest of the benefit education team, thank you very much for your time and attention. Enjoy the rest of your day, and we look forward to seeing you again in the future.
Take care, everyone.